Vanguard has a large suite of funds which are now available to UK investors, and in this video I'm going to show you behind the scenes how I go about exploring a set of funds, both from a data perspective but also from an analysis perspective to ensure that the graphs aren't misleading. This video is sponsored by ShareScope, and if you want to get the online version of the app, which is called SharePad, you can click on the link at the top right of this screen or on the link in the description of this video. If you subscribe using our affiliate link, then you'll be helping to support us and you'll get your second month of your subscription free. And if you go for the annual subscription, you'll also get your 13th month free of charge. If we're comparing lots of funds, a good place to start is by comparing risk and return. In many of my videos, you'll see these risk-return plots where we have high risk on the right, low risk on the left, and low return at the bottom of the graph, and high returns at the top of the graph. When we plot that for these Vanguard funds, and this is based on returns since 2014, you can see this very clear split between this group of funds here on the right of the graph. So these are the relatively high risk funds based on volatility. That's the typical annual percentage price move. And notice how all of these are either equity funds or they're long duration government bond funds. Then if we scoot over to the left hand side of this graph, you can see all of these funds are bond funds or fixed income funds. Unless the duration of these is very long, these tend to have a lower risk, lower volatility, but they almost certainly come with a lower return. So these risk-return plots are great because they can show you for a given level of risk, that's the position on the x-axis, which fund gave you the best return. Now what you never see in my videos until this one is the amount of work that goes on behind the scenes in creating a plot like this. So what I'm going to do is take you through that process. So maybe you'd like to recreate some of these graphs, or maybe you're just curious as to how it's done. So a key differentiator between funds is whether they're accumulation funds or income funds. Now the data that I use for my graphs generally comes from this application, which is called SharePad. And the way this display is structured is that on the left hand side we've got a panel which shows us the available funds. And in this case I've just got two funds which are two versions of a life strategy fund. Now Life Strategy is a very popular fund in the UK. This contains a combination of equity and bonds, and the 60% here means that it's 60% equity and 40% bonds. Plus if I look at the portfolio, if I break it down by the top countries, you can see that it's actually quite diversified globally as well. So the US makes up 40% of the allocation, 25% is UK, 6% is Japan, and so on. And if I break it down by asset allocation, you can see that it's very close to that 60-40 split. So stock makes up 59% and bonds make up about 40%. And what I'm going to do is compare these two funds side by side so you can see the difference between them. So I select both of them, I right click, and I compare selected shares. So this panel in green above me is Life Strategy 60%, but it's the income version of the fund. That means that any income which is paid by this fund will be paid directly to you in the form of cash in your brokerage account. Whereas the accumulation version of the fund takes any income which is generated by its investments and automatically reinvests them back into the fund. So that income actually appears to you as a capital gain. It's an increase in the price of the fund. So you might be thinking if we compare the price of these two funds, we should see the effect of that continual reinvestment of income. So that's what we're going to look at next. I right click on these two funds and I select multi-graph selected shares. So now what you can see is a graph that starts at 0% when the two funds are created in 2011. The black line is the income version of the fund and the red line is the accumulation version of the fund. Notice how over time, gradually, the red line is creeping upwards above the black line. And that's directly as a result of the reinvestment of the income that comes from its investments. So over the decade since 2011, you can see the accumulation version is up by 130%, whereas the income version is up just under 100%. But for the income version of the fund, you'd have received cash in your brokerage account, which you could have chosen to reinvest in the fund. Now, from the point of view of these graphs which I create, obviously you wouldn't want to compare income funds with accumulation funds because it wouldn't be fair. Because the income funds will look as if they've got lower return, So you should always compare like with like if possible, and show income funds with income funds and accumulation funds with accumulation funds. Now this doesn't apply if you're comparing US funds, and that's because US funds don't have accumulation versions. One useful function in SharePad is that it lets you compare funds based on their dividend yield. To show you what I mean, let's go to the left-hand panel here, and what I'm going to do is sort by 12-month yield. So I just double click on this, and now you can see the highest yield fund at the top here, and if I scoot down, you'll get to the lowest yield fund at the bottom. Now in our case, it's 12-month yield, so that's the dividends paid out by each of these funds over the last 12 months, divided by the price of the fund today. I know that some of you like to invest based on income, so this is a tool which lets you do that comparison very easily. So now that you've seen SharePad, which is a source of the data that comes into my graphs, I'll now give you just a quick overview of how those graphs are generated. So the first step is usually to create a group of funds in which I'm interested. They could also be a group of shares or bonds or a mixture of all three. The next step is usually to export the prices into a text file, which is called a CSV file, a comma separated value file, which I can then import into the statistical package R, which is what I use to generate my graphs, but also to do a lot of analysis. Now, a lot of you comment that the graphs look good. I can't take any credit for that. That's all down to this guy who's called Hadley Wickham. He created the ggplot2 library, which is why the graphs look good. So we'll just quickly go through that process so that you can see how it's done. Now, whenever you deal with lots of funds or lots of stocks or bonds, it's always good to have a unique identifier for a given fund. Now, sometimes people use tickers, but tickers vary between different platforms. For example, Bloomberg will have one ticker, the application you just saw, SharePad, will have another, and it's not universal. So that's why it's always good to use an ISIN code. ISIN stands for International Securities Identification Number, and you can see 5 of them beside me here for the 5 life strategy funds from Vanguard. So if I want to load these 5 securities into a portfolio in SharePad, I first select the text containing these 5 ISIN codes, and then in SharePad I select Portfolio, New Portfolio. So let's call it Vanguard Test Portfolio, and we'll denominate it in pounds sterling. Currently the list is empty, so I'll select Add to Portfolio, and I'll add multiple shares, and then I paste in those 5 ISIN codes for the Vanguard Life Strategy funds. And then I click on Look Up, and SharePad looks in its database of ISIN codes, and it's found these 5 unique funds. And here they are now. These are the 5 life strategy funds which we wanted to upload. So I'll select all of these funds and I'll do a multi-graph so we can look at their returns, and I'll get rid of the left-hand panel so we can see that more easily. And you can see very clearly that the dark black line, which is Life Strategy 100, which is 100% equity, is the fund which has performed the best over this period of time. Now there's a lot you can do in SharePad, and if you're comparing prices, for example, I often do that during a YouTube live. Or alternatively, if I'm doing a power hour with a client, I often call up their fund's returns. But if I do want to go deeper into the analysis side of things, then I usually export the prices from SharePad into R. So let me just quickly show you how to do that. I click on the Prices tab here at the top, then I click on Sharing, Export Data for List, and choose Export All Data. Then I click on OK, and it spews out a comma-separated value file. Now this is what R looks like, and it's got nice code highlighting here in the left-hand panel, and it's got pretty graphs here on the right-hand panel. Now over the years I've built up quite a big library of functions in R which let me analyze that data from SharePad very quickly. And if I run that code, which hoovers up that CSV file, and then if I run risk return plot, this is what you're familiar with seeing in many of my presentations. Now the reason this is so quick and easy is because the data is clean. If you try to get the data from free sources, often what you find is gaps in the data, or missing values, or big spikes in the data, or periods when the price gaps down to 0. So just having clean data from SharePad is worth my subscription. When you're constructing a portfolio, diversification is incredibly important, because by carefully combining the right funds, you can reduce the overall risk of your investments. To see why that's the case, we can compare the returns on two funds. Both of these are Vanguard funds, and on the x-axis here you can see the daily return of a North American fund, whereas the returns on the y-axis are simply for the US. So if we plot the daily returns of the North America fund versus the returns on the US fund, they match each other almost exactly. So if you buy both of these funds, it wouldn't make a lot of sense. Really, you're buying the same fund. A lot of the stocks will be in common between the two funds, and it's not going to reduce your risk at all. In this graph, we've got the same fund on the x-axis, that's the North America fund, but now on the y-axis, we've got the returns of a UK gilt fund, which buys UK government bonds. The two are not strongly related. When North American equity moves up or down, gilts basically don't give a damn. And that's exactly why UK gilts are a good hedge for US equity. Now the problem you can see straight away here is that when you have 11 funds to compare, you've got an 11 by 11 matrix. And now that Vanguard has about 100 funds to choose from, it becomes almost impossible to choose funds which aren't correlated. And this is where the statistical language R comes into the picture, because what we can do really easily is create one of these trees. Now the way the tree works is if two of the funds are very closely related, as we saw previously with the S&P 500 and North America, then they tend to be close together in the tree. And if we have a 50-50 portfolio consisting of those two funds, the volatility of the overall portfolio is roughly equal to the volatility of each of the funds. Whereas if we choose funds from different parts of the tree, and here we've got that North American fund combined with UK gilts, which as we saw is uncorrelated, notice how the combined volatility is comparable to that of the bonds. So this is the alchemy of diversification. And what this tree lets you do is compare very many funds to see which ones are closely related and which ones aren't. So if we cut the tree here, we get 6 different groups. And because equity tends to be very excitable and have lots of action, I called that the Scooby-Doo branch. So if you want some Scooby-Doo in your portfolio, then you go for one of these funds in red. The second group here is for European equity, and because I wanted that to be like Scooby-Doo but smaller, I made that Scrappy-Doo. And then for the FTSE 250, I chose Shaggy, who's Scooby's sidekick. Then we get to the kind of boring preppy parts of Mystery Incorporated, and that would be the boring bond funds. So Fred would be the dollar-denominated bonds here, Daphne was the euro-denominated bonds, and Velma was the very boring UK government bonds. If we update the tree using the latest data, this is what the tree looks like. And again, it clusters very cleanly into equity at the top here and bonds at the bottom. So that would be your Scooby at the top and Velma at the bottom. So for example, with my Vanguard portfolio, I've just got one global equity fund at the top here and 2 of the bond funds here at the bottom. So the Scooby-Doo tree provides you with a very easy way to choose uncorrelated funds which will diversify your portfolio without looking at these horrendous correlation matrices. So I hope that's given you some insight into how to construct a portfolio using Vanguard funds, but also how more generally to approach portfolio construction and how to balance risk and return. That's always the trade-off that we think about when we invest. And remember, if you do want to help support us, then that affiliate link will give you your second month subscription to SharePad free. And if you go for the annual subscription, you get your 13th month free as well. So, as always, thank you for listening.